First, we've got the measurement illusion. Second, the three elements of measurement. Third, we'll talk about the faulty yardstick. And lastly, the 4 valuation principles that accountants use to actually fix all of this.
All right, Section 1, the measurement illusion. Before we can really grasp accounting, we need to define what the word measurement actually implies in an economic context.
To ground us, let's look at how Professor R.J. Chambers, a total giant in accounting theory, defines measurement. He calls it the assignment of numbers to objects and events according to rules specifying the property to be measured, the scale to be used, and the dimension of the unit. Okay, a bit wordy, but notice what it's telling us. Measurement isn't just a random guess. It absolutely requires strict rules, a specific scale, and a precise dimension. You literally can't measure anything scientifically without locking those parameters in.
Moving right along to Section 2, the 3 elements of measurement. Let's break Chambers' definition down into a framework we can actually use. So according to the theory, any measurement discipline relies on 3 exact steps. Number 1, the identification of objects and events you want to measure. Number 2, the selection of a standard or scale to use. And number 3, the evaluation of the dimension of that scale. These are the exact step-by-step things an accountant has to figure out before recording a single transaction in a ledger. They have to know what they're measuring, what the ruler is, and crucially, whether that ruler is actually accurate. Let's take a closer look at that first step, identifying the objects or events. Accounting essentially measures economic information so people can make informed judgments, right? Decision makers need to look at past, present, and future info. Like, if you're a bank and you're about to give a loan to a business, obviously you need to see their past and present cash receipts and expenses. You got to know their current state of affairs. But to measure their true repayment ability, their capacity to service that debt over time, you absolutely need projected future receipts too. Now, while past and present events are things we can measure pretty accurately, future events, those have to be predicted. Prediction is just an absolutely essential part of the accounting information you identify. But here is where things get really dramatic. Section 3, the faulty yardstick. When we apply those next 2 steps, selecting the scale and evaluating its dimension, to accounting, we run into a really fascinating problem. This brilliantly illustrates the core issue we're dealing with. See, in the physical sciences, an ideal measurement scale is totally stable over time. If you go buy a kilogram of cabbage today, the physical quantity of cabbage you're holding is exactly the same as 1 kilogram of cabbage you might buy a year from now. A meter of cloth doesn't magically shrink over time, right? The dimension is totally stable. But in accounting, our scale of measurement is money. And as we're going to see, money has absolutely 0 universal denomination and really no true stability. We can actually prove this right now with a real-world scenario from the data. Imagine an Indian businessman takes out a $5,000 loan from a U.S. business. Now, money has no universal denomination, right? It takes the shape of whatever the ruling currency is: the rupee, the dollar, the pound, the euro. Let's say the exchange rate when they sign the agreement is 50 rupees to $1. So that loan hits the books at 250,000 rupees. But wait, over time, the exchange rate shifts to 55 rupees to $1. Suddenly, that exact same $5,000 loan is worth 275,000 rupees. The debt literally just grew, entirely because our measurement scale, money, is wildly volatile across borders. Okay, so the scale is super volatile internationally, but what about the dimension within a single country? Well, because input and output prices are always shifting, the exact same amount of money might not buy you the exact same quantity of goods on different dates, which means the actual dimension of money is completely unstable. Information from one year, when measured purely in money terms, might not actually be comparable to information from another year. And this leads us to an amazing plot twist. Just look at this company's performance across 2 years. In year 1, they pulled in 500,000 rupees in sales. In year 2, they hit 540,000 rupees. If you're only looking at the monetary figures, you're popping champagne, right? You're celebrating an 8% sales growth. But look closely at the physical quantity. In year 1, they produced and sold 5,000 pieces. In year 2, they only sold 4,500 pieces. Their actual production and sales volume dropped by 10%. That financial growth you're just celebrating, it's a complete illusion created by changing prices. The really crucial takeaway here is that money can absolutely lie to you if you don't understand its dimension. Check out the second half of this twist, where we factor in the cost of production. In year 1, their costs were 400,000 rupees, giving us a gross profit of 100,000. In year 2, costs jumped up to 450,000 rupees. So our gross profit for year 2 is now only 90,000 rupees. Despite that total illusion of an 8% revenue growth, the actual gross profit declined by 10%. Because money simply isn't stable in its dimension, accounting can never be a perfectly exact measurement discipline like physics. So, how on earth does the accounting profession handle a ruler that keeps changing its size? Well, they have to bridge the gap between those foundational elements of measurement we just went over and practical, real-world solutions. Since the monetary ruler is imperfect, accountants have had to develop a specific set of theorems and principles just to stabilize things.
Which brings us to our final section today. Section 4, Valuation Principles. These are the 4 measurement bases, or basically the ingenious tools accountants use to compensate for that faulty yardstick.
So, there are 4 generally accepted measurement bases used to value transactions. First up is historical cost. This is your traditional favorite, mostly used for long-term assets like machinery, and it's based simply on what you originally paid for it. Second is current cost, which looks at what it would cost to replace that asset today. Third, we have realizable value, which flips the whole perspective to what you could get if you turned around and sold that asset right now. And finally, present value. This one is super common when you're accounting for things like investments and loans because it actively factors in the time value of that fluctuating money we've been talking about all day.
So I want to leave you with a final, kind of provocative thought to ponder. We've clearly seen that accounting absolutely requires the strict rules of a measurement discipline. You have to identify objects, you have to select a scale, and you have to evaluate its dimension. But we've also seen that its primary scale, money, is inherently volatile. It literally forces accountants to use all these various valuation principles just to approximate the truth. So if our measuring stick is always changing, is accounting truly a strict science, or is it actually more of an art? It's such a fascinating question, and one that really proves business valuation is way more dynamic than just simple math. Thank you so much for joining me on this explainer. Keep asking questions, and I'll catch you in the next one.